probably the thing that has frustrated me most speaking to e-commerce entrepreneurs is they seem to not have done their homework into what best practice is and how real successful businesses are cost paid for exits.
Hello, I'm your host, John Cavendish, and welcome to Season 3 of the Amazon Strategist Show, the show that's all strategy with no hacks, no silver bullets, and no magic pills, just real practical strategies for your Amazon business. So today we are joined by none other than Emmett Kilduff from the Fortia Group. Emmett has been involved in over $20 billion, with a B, dollars of corporate transactions and deals since the year 2000. He's a strong interest in e-commerce, and since completing his master's in e-commerce in 1999, we can maybe talk about that. I wonder what e-commerce was like in 1999. With over a decade leading investments at Morgan Stanley, Credit Suisse, Emmett has billions of dollars of corporate finance experience. So, Emmett, welcome to the Amazon Strategist Show.
Thank you, John, for having me.
Well, great to have you here. So, actually, I didn't read that before, but 1999. So what did you cover in your degree? And is anything still applicable 25 years later?
Yeah, I did a degree in business and law, and then a new master's came on the curriculum called the Masters in E-commerce, and that just sounded incredibly funky at the time. And there was no books available at that point, really, about all the things we now know well. So the tuition was really through speaking to entrepreneurs or people that were doing startups. As you might recall, like 99, 2000 with the dot-com boom, it was one of the best periods for PowerPoint decks and startups and raising money. And so there was no shortage of people trying to jump into dot-com and e-commerce, which made it really interesting. People were trying to really get a grip on what is e-commerce. How can I get $1 billion unicorn startup going? So it was fascinating. And after I did that, it was in the midst of the dot-com boom. The IPOs were just crazy at the time of the likes of Google and Amazon coming to market. I wanted to get a piece of that, so I put my hand up to join investment banking out of London and started doing corporate finance deals.
Nice. And so since then, you managed to escape from London back to Ireland. Is that where you're based now?
Correct. Yes, I left London in 2012, just after the London Olympics, and I've been home, for 12 years now in Ireland.
Oh, that's great. Yeah, I did London for a few years, but I'm also a fan of leaving it after a while and going back somewhere else. Cool. So for Fortia Group, I know we had someone else from the Fortia Group around 18 months ago on the podcast, and I think the market has changed a little bit in the last 18 months. So what are some highlights of what's been going on over the past 18 months?
Well, look, to be honest, the last 2 years have had declining M&A volumes. In every sector and size across the world. Valuations have obviously come down. Deal volumes have come down. Interest rates are still high. So it's a really tough environment. And then from an operational perspective, your listeners will know, margins are getting squeezed left, right, and center. It's quite tough for operators. And the good news is that we can see the light at the end of the tunnel. From my perspective, from a corporate finance perspective, there's a good chart by Goldman Sachs which shows that M&A volumes have never decreased for 3 years in a row. So we've had our 2.5 years nearly, and we expect volumes to increase. And that's important because it just increases the chances of your listeners to just get a deal done. We can talk about valuation after that, but actually getting a deal across the line is a good result, right now, depending on the circumstances. When interest rates come down, particularly in the States, that will be a catalyst for increased volume, but also more capital for acquirers, lenders to put to work, and therefore, slightly increasing valuations. I don't think the valuations will get back to the lofty days of December 2021 when some FCA brands were going for 7x. That was the highest number I've heard, 7x, which is, incredibly high. We're not going to get back there. We need to manage expectations of your listeners, but we should A, get more deals done, B, have more fair valuations.
Yeah. I love it. Don't love it because as things haven't been going better, but I love the opportunity for the future. And as they say, when there's blood in the streets, it can be time to make a move. So when that money starts moving around, how how would any of our listeners become like a good deal to be snapped up by some of that capital that starts to get released?
Well, one maybe left field idea for some of your listeners is don't be afraid to be thinking about acquiring another business in your space. Sometimes people think M&A is always the sell side for companies selling to others, but it is a good time to be a buyer and maybe consolidate with some of your competitors. It doesn't always have to be cash trading hands. It could be a cashless merger in order to become a bigger business that's more attractive to bigger, more institutional buyers who pay higher multiples. So that's one thing just to keep in the back of people's minds. If one wants to exit next year, you've got to start planning now. Let's assume interest rates do go down in Q4, touch wood, in the States and at the Fed. Then going off the back of, pricing a deal off the back of 2024 numbers, assuming the accounts are annual calendar basis, that's a good time to go to market. But that leaves sort of, 6 months to do what we call early preparation stage 1 and final preparation stage 2, and that's relatively tight if you want to do it from a best practice perspective.
Cool. So stage 1 and 2, can you break those down a bit? What early preparation and final preparation are, and what's included?
Yeah, most people don't do any early preparation. Most people go straight to final preparation, which is list and go. We don't get involved in listings. We're more like we have a Wall Street white glove approach, and we produce a 2-page teaser, a 50-page deck, bespoke data room, and we don't go to market until they're at a Rolls Royce really, really high standard. But to get to that stage, you need to take a step back and have an early preparation stage, which is everything from us or a firm similar to ours, looking under the hood, looking for the skeletons in the closet, being a proxy for acquirers and saying that's a red flag, we need to change that. Looking at short, medium, long-term changes that can be made to add to valuation. And I'll give you some of my favorite quotes in M&A, which will support stage 1. Number 1, the best laid plans don't only survive contact with the enemy. They only survive until contact with the enemy, right? So even if you think you've got a great business and got a great deck to sell it, who cares, frankly? It's what the buyers think. They're the enemy. So one of the things we like doing follows the whole flirt, date, marry approach. When we take a client on early, we like to get their business in front of buyers that might buy it next year to get feedback. What do you think of the business? How is it positioned today? What tweaks would you make? What would you like to see? Is repeat purchase rate good enough? Et cetera, et cetera. And so then you can incorporate that feedback, and hopefully when you go to market, you've got something that's more tuned into what buyers want. That's really important. The other great benefit of the flirt, date, marry approach is the best quote of all time in M&A is the best businesses get bought, not sold, right? And to do that, you have to be prepared to sell, and you've got to have your ducks in a row, your data room ready, etc. When you're flirting in the flirt, date, marry approach, when you're flirting, we often say to people we're flirting with, if you want to take this off the market and not let the Fortia group start a competitive formal auction process in Q1, send us an offer, send us a bid that we'll take seriously, and we'll socialize that with the entrepreneur. And if it's attractive enough, you could potentially take us off the market. That's when you get bought, not sold. That's a really good result for the entrepreneur. It's something we like to try and pull off. It doesn't happen as regularly as one might want, but the smart firms, particularly on Wall Street, are thinking that way. We're trying to bring that blueprint or approach, John, to smaller e-commerce companies.
No, I love it. And I love the flirt, date, marry, and also, just people buying it. So what kind of percentage of deals do you think people that actually get bought, get an offer put in prior to you going to market?
Very little, especially in e-commerce, because very few companies are doing stage 1 early preparation. They're not even aware of it as a stage. They just rush into, listing on a website, which I think I just from my background, I can't accept as a way to do an exit. I think it needs to be much more bespoke. It works for very small businesses, but when you get to 5 million revenue or plus, you need a more, in my view, white glove approach. And And so, yeah, I think the answer is very, very small because people aren't even aware of the other 7 stages of the best practice exit process. And that's something we're trying to do at the Fortia Group, is educate the market continuously. We have a 90-page exit guide for FBA entrepreneurs that we co-authored with 20 acquirers to do just that, to sort of explain the whole process of M&A.
Love it. Where can someone get that guide?
Yeah, it's complimentary to download from our website, John.
Okay, fortiagroup.com. Is that right?
That's it, yeah.
Awesome.
Yeah,
cool.
Thank you.
You should plug that all the time. Awesome. So next, you say from the fortiagroup.com, just head there, give us your email address. So when you say smaller businesses, what's a smaller business to you? Because you mentioned 5 million and you said you want to bring the M&A from the bigger companies to small. What's big to you, medium and small to you?
Yeah, it's interesting. It's changed over the years. So when the Thrasio of this world entered the space, 4 years ago or so, they were all looking to do acquisitions of brands with about a circa 1 million revenue and above. And as the years went on, the significant majority of those have increased that minimum threshold towards 5 million, and in some cases higher. And so that makes it harder to sell smaller brands to institutional investors. And you take away the Thrasios of the world, the 100 plus aggregators, then you were left with the folks that were there before we ever heard of the term FBA aggregator. And that's typically individuals that have made money by selling for example, in the same category, smaller family offices. So what I'm saying now then is to sell to an institutional investor, which could be an aggregator, of which there's both FBA and DTC, a private equity firm who owns a company, you might want to bolt on your business to it, or a strategic, a small competitor or firm in your space. You really need to be doing, from an FBA perspective, at least 5 million in revenue.
Cool, 5 million. And what kind of margin would they be looking for on that?
Yeah, net margins, like the acquirers are looking for at least 15% net margin for FBA-led businesses. And valuation depends on loads of things, but you got in this market, quantum of revenue is the first thing, then revenue growth, net margins, things like simplicity for integration. They don't want to see 3,000 SKUs, and there's lots of other factors that we could go into. The typical range we're seeing for growing and profitable FBA-led brands today, John, can be anything from 2x to 6x. Now, getting towards 6x is diamond territory or unicorn territory. And that range includes upfront payment and deferred payment. It's the total consideration for a business. We sold earlier this year a business that had incubated 6 Amazon brands, and that priced for circa 5x. It was doing tens of millions of revenues, 5x, which is very, very handsome. The sellers were delighted. Right now, I'm not saying I can get 6x for your listeners. If you want anything near 5, you've got to have a big quantum of revenue, great growth, great net margins, good net margin trajectory. You've got to be in a great category. So right now the categories where there's the most demand are pet, baby, beauty. So it helps if you're in one of those categories. You got to have amazing repeat purchase rates. You got to be a brand with a capital B, not a product. There's lots of things that we could jump into. Every quarter, John, we publish a 50-page guide that details our thoughts on valuations of e-commerce brands. And we go through that in detail with some guest speakers on the webinar. Your clients can go to the fortiagroup.com and register for that webinar if that's of interest to jump into more detail.
Cool. I love it. And so just for the clarity of anyone listening to this, when you say 15% net margin at these size businesses, is net margin after team? Because a lot of businesses, Amazon businesses, are sold on literal seller discretionary income. And what kind of size teams are you looking at for these businesses? Because I assume a private equity wants a business that operates itself as opposed to having to install a whole operating team.
Yeah, it depends. It depends what's right for the business at hand. So sometimes you need more people, sometimes you don't. I think It's interesting you say that. Actually, the aggregators initially were a little bit too confident, maybe, and didn't think they need to retain the entrepreneurs. And
Yes, very confident and very poorly confident.
yeah, you need everything that's in the IP in the heads of entrepreneurs because to keep the business going. So I think the aggregators learned from private equity, who for the last several decades have always kept people on through earnouts or other incentives, and so any smart buyer is going to keep people on, in my view, unless it's a bolt on to something bigger, where they have a management team that's proven and can move, sunset the selling management, relatively quickly, but. It's a warning signal. If the entrepreneur says, I want to head to the beach next week, that's a warning, a big red flag,
Yeah, I would agree there. And so would net margin be after team costs? And what kind of percentage would one of these businesses really be spending on team usually?
Yeah, good question. So you can have SDE plus add backs. Then you get into the definition of add backs. 3 or 4 years ago, acquirers were quite lenient into what was allowed to be allowed in. Now they're much, much stricter. It needs to be one-off costs or founder salaries. They're not being as lenient. Of course, if you can create a really competitive auction and there's 5 bidders, then you can start to push back on a few points and negotiate more favorably. But right now the market isn't there. We know we're not. We had one bid where we had one business, where we had 12 LOIs, and when you have that number of LOIs, you can negotiate. The dot the I's and cross the T's till you get exactly what you want. But we're not there today. So, entrepreneurs who try to get too creative with ad backs are trying to manage expectations. I think we have to be realistic, given where we are in the market.
Oh no, I agree. But as if I was going to sell, or if anyone else was going to sell, I'm sure that they are creative as humanly possible. I would add back absolutely anything, and then move. That's where we start from. But yeah, that's great. I love it. So, at this part of the podcast, we asked for a controversial take. So, Emmett, do you have something you'd like to share of your most debatable or controversial opinion related to Amazon or the e-commerce industry in general?
This is probably partly where I come from, having had the lucky opportunity to work for a company like Morgan Stanley, one of the best M&A firms in the world on Wall Street. If you're Elon Musk or Richard Branson or any of these folks, and you're looking to sell your business, you've started thinking about doing that 1 to 2 years out. And what really frustrates me, probably the thing that has frustrated me most, speaking to e-commerce entrepreneurs, is they seem to not have done their homework into what best practice is and how real successful businesses are paid for exits. And also, most big successful businesses all have a board of advisors, if not an advisory panel or a team of serious mentors. I don't see that there either. So that's what's disappointed me, frankly. And I have other businesses. They all have boards because I want more gray hair than I have advising me, because they've all made the mistakes. Why wouldn't you have advisors advising you? If I have a great pet business doing 5 million, I want someone who sold their pet business 3 years ago for 50 million on my advisory panel. I want to give them share options, so that I do things right. That's my bugbear.
Yeah, and I would agree with you there. I'm sure many of our listeners who've got friends or contacts in the Amazon or e-commerce industry have seen it before. I know I have, of people getting sick of their business. They've been operating and it just becomes something they don't want to do anymore. And then they want to sell, and they usually want to sell relatively quickly. And that's the problem. They're not prepared to sell. And so, yeah, I would 100% agree with that. Head to the Fortia Group's website, download their 90-page guide and start working through it, because, we still be ready to sell at any point. Because as you said, if we're approached by a proactive buyer, it's great to have all the financials already up to date and in place and not be digging through a bunch of stuff. And, as we all know, what we report to the accountant isn't necessarily what we'd call the operating profit of the business or anything near the books you'd want to share with an acquirer.
Yeah, agreed.
So I think we're getting towards the end. So that was one amazing discussion. So thank you so much, Emmett, for being a part and for sharing your knowledge and your experience of $20 billion of acquisitions. And I think you've got everyone thinking about acquisitions and exits now. So now's the time to think about it. Spend an hour or two just thinking about what you would do with your business if you wanted to sell it, how it would operate, what you do if you wanted to go and sip pina coladas or start a new business. So if anyone wants to contact you, follow you, get more information, what's the best way to do that, Emmett?
Yeah, please send them to fortiagroup.com, John. Thank you.
Okay, awesome. So we'll leave that link below wherever you're listening to this podcast. And I hope that all of our listeners, you found this episode useful and taken some insights away. So if you'd like to leave a review for the podcast, rate us on whatever platform you're listening on. You can even do that on Spotify now. Please do rate us and check back in next week for another episode of the show. So thanks so much for being here, Emmett. See you soon.
Yeah, really appreciate it. Thank you, John.